Have you compared VUG to VTV lately? Pretty interesting. I don't know what it did today. I have no idea what the markets did today. Or yesterday, I don't think. Anyway, maybe I did. Yes, yesterday they were up, if memory serves. Anyway, VUG, I think, was down so far this year to date, 12%, something like that. Where VTV is up, less than 1%, but that's a 13% swing right there. I would expect more of that, my friends. I would expect more upside for VTV, which is the value index fund, basically the dividend payers, if that makes sense. The growth stocks have a hard time. Look, I could be 100% wrong, dudes. 100%. One thing I do know, once they start paying dividends, it's awful hard to not pay the dividends. Look what happened to GE when they cut AT&T's dividends and whatnot. I mean, you're going to get smashed if that happens, but hopefully the vast majority of companies you own in a ETF or mutual fund don't have companies that are reneging on their dividends, if that makes sense. So anyway, point being is, I've said this 1,000 times a Sunday. We've had a significant run in growth stocks the last 5 years relative to value stocks. I mean, growth stocks for the last 13 years have had a significant run. Value stocks have run without question. Anyone's griping about value stocks and kiss my big fat behind. But value stocks relative to growth stocks, the last 5 years, it's just been nuts for the growth stocks relative to value stocks. And all that stuff always reverts. It does. I'm not sure if this is the beginning of that. I think, I don't know what's the last 6 months have done value to growth. I don't know. But you want dividends, man. Dividends just make you feel good inside. Oh, part 2 of this. Make sure you reinvest your dividends. I looked at my Schwab account yesterday, and all my stuff had dividends not reinvested. I was like, dude, I want my dividends reinvested. What the hell? I don't want to put in cash. I couldn't believe it. I was like, huh? Anyway, the point being is when you're reinvesting dividends, you're dollar cost averaging. So you get a dividend payout when the stocks go down. You're buying more shares when the prices are down. That's how you build wealth right there, my friends. Buy shares when the prices are down. DCA, baby, dollar cost averaging. Now, growth stocks, the problem with growth stocks, you're just relying on literally the price appreciation. And a lot of times that price appreciation is very suspect. It's subject to people's feelings about the company. I think this stock will do better. Okay, why? The potential for earnings are high. Okay. And what typically happens when that potential in any quarterly earnings call is less than expected, kaboom, kerplink, kerplank, kerplunk. Anyone know where that's from? Think about it. Kerplink, kerplank, kerplunk. Any of y'all from Maine should know this, my friends. If you don't know it, if you're from Maine, turn in your Maine badge now. Put in the show notes if you know where kerplink, kerplank, kerplunk is from. If you're from Maine, turn it in. Send me your Maine badge. Anyway, so what happens with earnings? If the earnings aren't good, the stock goes down because, that's what I'm basing my futuristic price appreciation assumptions on, higher earnings. With dividends, on the other hand, as long as the dividends get paid out and don't look like they're going to get cut, there's a good chance that stock won't go down as much and even might go up more, especially if earnings are inferior to what's expected from the growth side. It's a pretty interesting dynamic. Anyway, you want to buy a company with good earnings, not too highly priced, good potential for a continuation of dividends, not a high dividend payout ratio. And that's, in my opinion, that's what you bank on. And we'll see if it shakes out. But it looks like so far it has this year. I will see you.